What happened yesterday? Inflation data came in worse than expected. Dow Jones estimated that inflation would come in at 8.8%. It came in 9.1%. That was way above expectation, worse than everyone expected. But what happened to the market? The market didn't seem to really give a shit. The market went, well, meh, right? Now, initially, the market did go down. If you take a look at the charts, these are the intraday charts. This is the NASDAQ. So the NASDAQ initially gapped down, but then recovered most of the initial losses. S&P 500, same thing. Let's look at the S&P. So again, this is the intraday chart. The data was released, it gapped down, but then it recovered back. So at the end of the day, the market still ended down, but only slightly. As you can see, the S&P ended down about 0.45% and the NASDAQ ended down 0.15%. Now, usually, if you've got hot inflation, people expect that the Federal Reserve will have to be more aggressive, raising interest rates even higher, and that's really bad for tech stocks. So you would imagine that with that inflation data, tech stocks should crash more than the S&P. But no, tech stocks actually performed better. It didn't go down as much as the S&P. So why did this happen? Why does the market not care that inflation is worse than expected? Because the market has realized what I said in my last video last week. The market has realized that inflation has already peaked. And inflation, in fact, is already coming down. And that's why the market is looking forward and not backwards. You see, you got to understand that the data that you get yesterday, it's not real time. The data that you see is a lagging indicator. It's based on the inflation in June last month. But as I said in my last video last week, if you take a look at the actual current market data of commodity prices and energy prices, they're all coming down. They've broken their uptrend. Many of them are now in a downtrend. So that means the market knows this. The market knows that inflation has already peaked, but you'll only see the data in the following couple of months. So as investors and traders, we have to look forwards and not backwards. So once again, let's take a look at the data. So remember, there are two main things that are driving inflation: food and energy. If you take a look at energy, let's take a look at oil futures. So oil futures would be this chart over here. And let's look at the daily time frame. All right. So you can see that this hot inflation data was based on oil prices over here, right? Which peaked here. But currently, you can see that this uptrend has now reversed down, and oil prices are now beginning to trend downwards. But you won't see this in the report that reflects last month's inflation. This will come out next month. So oil prices are coming down. How about natural gas prices, which people say are going up because of the war in Europe, right? If you look at natural gas prices, same thing. You can see it peaked a couple of days ago, but now you can see that it has begun to reverse down, although it may be trending up, bouncing up a bit over here. So energy prices are coming down. Now, how about commodity prices? If you take a look at specifically agricultural commodity, you can look at this ETF called DBA, which tracks agricultural commodity that affects food prices. What do you notice? My God, check it out. What happened in the last couple of weeks? This uptrend has been broken, is now on a downtrend. So food costs are coming down. These are live numbers that you have to look at and not the lagging indicator of the CPI. And that's what the market's looking at. Let's look at a DBC that overall looks at the entire basket of commodities. And same thing you get over there. You can see this trend line over there, right? It peaked here. And then we had this trend line support that was broken. And then we had this horizontal resistance support that was broken again. And now it's clearly on a downtrend. Next, take a look at the 5-year break-even inflation rate, which I've mentioned before in my last video. This 5-year inflation rate is a leading indicator of the current inflation rate. So this tells you what the market expects inflation to be in 5 years. So what happened yesterday when the CPI came out higher than expected? You would expect that this 5-year inflation rate would jump, right? It didn't jump. So what happened yesterday? All it did was it went like that. Meh. Okay, it just went up a small blip, right? In other words, the 5-year break-even inflation rate is still going down. You can see this very clear trend line over here. It peaked here, and now it has broken that trend line. And that's why, like what I said in my last video, inflation has very likely peaked. Oil prices are coming down, gas prices are coming down, commodity prices are coming down. So what does this mean? This means that the Fed's job is almost done, which means that they can stop being so aggressive in increasing interest rates. Now, does it mean that they're going to stop raising rates? No, I think they're still going to raise rates in the next meeting, which is on the 27th and 28th of July. They're expected to raise interest rates by another 75 basis points or 0.75%. Now, people are saying that, hey, maybe they may raise by 100 basis points, right? You know, whatever, 75, 100 basis points, doesn't matter. But my guess is that after the next meeting, which is late July, once they do this final raise, I think more or less that's it. They're not going to raise anymore. In fact, they may even start cutting interest rates next year after pausing for a while. Again, I don't know for certain, I can't predict the future, but that's a really, really bullish sign. And the market knows that. And that's why the market, as you can see yesterday, didn't really go down that much. All right. Now, could we be near a bottom in the market? Maybe we could be. One of the things that I've learned over the years is that bottoms are made. Bear markets end not on good news. Bear markets end on bad news. So usually what happens is that when you get bad news, market goes down. Bad news, market goes down. Bad news, market goes down. But when you have bad news, but market doesn't go down, that's usually a sign that something's changing. That's usually a sign that the market is beginning to form a bottom. And that's why, like I said in my last video, I think there's a very high probability the market will bottom and rally strongly in the second half of this year, which we are in. Now, does it mean the market will bottom right now? Maybe not. Why? Because, again, we got to look at the charts, and we always wait for confirmation on the charts. If you take a look at the actual charts of the S&P 500, we don't have a bottoming pattern just yet. Why? Because we are still on a downtrend pattern, as you can see over here, right? So you can see it's still a downtrend, right? Dung, 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 downtrend, 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 right? So we're making lower highs and lower lows. And I drew a bit of a counter trend line over here, and you can see it kind of like broke that counter trend line a bit over here. Now, I do have to say that, yep, in my portfolio, I've got all these stocks that are going to go up in the long run. You know, I keep adding to my positions, but at the same time, I do hedge my investment portfolio. So I do have a couple of short positions going on to hedge my long positions. So over here, in fact, when you see that the market broke this trendline support, I did add on some bear put spreads on the S&P futures as a bit of a hedge. So if the market does go back down again for another double bottom, then I can make some extra money from my short positions. Now, will it happen? I'm not sure. Again, we can't predict 100%, so we need to always have plan A and plan B, right? So my plan B is that if the market comes down again, I make some money from my short positions. But if the market is able to bounce back up from here, then of course my short positions, I'll just cut loss on those, and then I'll make money on my long positions. So you always need to have plan A and plan B. Before we move on to the next part of this video, I've got exciting news and announcement. I'll be conducting a free live online event for all my viewers really soon, where I'll go into detail on how I identify and analyze the best stocks in the market that will survive this uncertainty and help you to profit from the rebound. I'll also teach you how to develop the psychology of a winning investor and show you my ultimate investor's watch list of stocks that's going to lead the next bull market. So registration is opening really soon. Seats are very limited. Click on the link in the description right now to be placed on our event priority list, and my team will send you an email invite really soon. So I look forward to seeing you at the event. Now on to the rest of the video. All right. So again, for those of you who are waiting for a market bottom, could this be the bottom? We don't know. We don't know until we see confirmation from the charts. And what confirms a change in trend? For the trend change to be confirmed, number one, we need to see that prices get back above the 50 moving average, this blue line. But not enough. We want the 50 moving average to start sloping up the 20 EMA to cross back above the 40 EMA, which is the red dotted line crossing back above the blue dotted line, that would mark an early stage trend reversal. And then eventually when it breaks above the the 50 moving average gets back above the 150 moving average, that will be a very, very sustainable change in trend. So that would happen. Not right now, but it will happen in the next couple of weeks or months to come. So I'm watching this really, really carefully. Okay. If you look at the NASDAQ is in fact slightly stronger, which is interesting, right? Because NASDAQ, which contains tech stocks, should actually be more bearish, but it's actually more bullish, which tells you that, hey, inflation probably peaked and the Fed is going to cut back on its aggressive monetary policy. So again, if you look at the NASDAQ, sure, the overall trend is still on a downtrend, as you can see. And recently it hit the 50 moving average, but it has now a counter trend support over here. So it's at this support. Now let's see if it breaks this support. If it breaks this support, then again it may make another low for the year before reversing back up. But if you can stay above this counter trend line support and we do get a bounce from here, could be a trend reversal. So again, we have to watch. Can it get back above the 50 moving average? Can the 50 moving average start sloping up? Can the 20 cross back above the 40? We're watching all these signs right now. So essentially, if you are a long-term investor, you've got an investment portfolio, no worries. You're holding great companies that are making money. They will rebound very strongly. If not second half of this year, which I expect, then next year, right? But if you're more of a trader, then obviously the market is still on a downtrend. You want to be short buyers. You're still short buyers. Now, in my trading account, I've got short trades, I've got long trades, but a bit more short than long trades because I'm, again, going with the trend, right? But again, the moment I see a change in the price action, you could always look at the price action to confirm your entries, especially for shorter term trades. The moment I begin to see that this begins to break above the 50 moving average, 50 starts sloping up, 20 crosses back above the 40, I see higher highs and higher lows, I close my short positions and I go all long in the market, right? So waiting for that to happen, let's see if that happens. Some people have been asking me a bit about the US dollar and gold, so let me talk a bit about that since I'm on the topic of doing a quick market update. So first of all, if you look at the US dollar has been really, really strong against every other currency. And if you look at the euro, let's look at the euro versus the US dollar. Now the euro, as you know, has plunged to near parity against the US dollar right now. Okay, so you can see, whoa, the euro on this really, really strong downtrend against the US dollar. Now, if you take a look at the longer term charts, let me go back 10 years. Or let's go back even further than that. Okay, there we are. Now, I don't know how many of you remember this. I remember it so clearly that about 10 years ago, this was just after the financial crisis, the euro, this is the euro USD, the euro was at 1.6 dollars. It was 1.6 US dollars to 1 euro. Okay, so at that point of time, a lot of people said the US dollar is going down, the US dollar is getting worthless, we only want euros, screw the US dollar. I still remember at that time, celebrities even said, you know what, I don't want to be paid in US dollars because US dollars are trash, pay me in euros. That was a time when the euro USD peaked. So, and that's why I keep saying that markets tend to reverse when the majority think one way. When everyone thinks that the US dollar is going to die, and the euro is going to dominate the world, that's when it reverses back down. And I still remember at that time as well, a lot of people started talking about cryptocurrencies like Bitcoin at the time. And they say, you know what, the dollar's going down, fiat currency is useless, it's all about Bitcoin, Bitcoin's going to hit inflation. And what happened? The complete reverse happened. Now that there's inflation, Bitcoin collapsed and the US dollar is going up. All right, so you gotta be careful listening to the majority because the majority are always wrong. Now the opposite is happening. So right now you can see that no one wants the euro. Right? They say Europe's in trouble, it's in crisis, and right now you can see the euro USD just breaking this support level. Right, and now it's the opposite. So again, I'm a contrarian. So if you ask me now, Will the Euro USD keep going down? No. Once it gets oversold, you can expect a sharp rebound in the Euro USD. But not just yet. I'm watching the charts. I'm watching the candlestick patterns. I'm watching signs of a reversal. All right. How about gold? A lot of people were, asking me about gold a couple of months ago, and I said, don't touch gold. Why? Because always remember that gold tends to move the inverse of the US dollar. When US dollar goes down, gold goes up. Dollar goes up, gold goes down. So now that the Fed is on a rate hike cycle, okay, they are raising interest rates, dollar goes up and gold goes down. And that's why you can see that gold has gone down. This is a simple relationship, right? However, if you take a look at gold, gold is beginning to look a bit interesting for a short-term swing trade, but not just yet. So you can see that gold is now a bit oversold, and it's hitting this pretty strong level of support. Looking at weekly candles, you can see gold is right now right at this weekly support level. So I'm going to look at how gold closes the week tomorrow. If it closes with a bullish pin bar or a strong bullish candle, then maybe I may take a bit of a short-term long trade on gold using options. Right? I don't buy gold as an investment because I think the long term it's a non-productive asset, very low returns in the long run. But if I look at short-term trading opportunities and I see a quick bounce, I may use certain option strategies like a bullish synthetic spread or a bull call spread, or even we'll see how it goes, right? Okay, so this has been a market update. Hope you learned something. May the markets be with you, and let's enjoy the rest of the ride this year.